we've of course been speaking to the who's who of India Inc., the biggest of market experts, policymakers. Here's one more. Madhusudan Kela, who came to the ET Now headquarters in Mumbai ahead of the union budget. Here is that conversation between Madhusudan Kela and ET Now managing editor Nikunj Dalmia.
Let me first set the context with you because budget backdrop is very important. The backdrop in last 3 years has changed. 2021, it was about surviving the COVID crisis, so government had to spend more. 2022 was about stability because economy was coming back from survival, it became revival. But now is the flourish moment, the push for growth. So if you can explain to our viewers that what to your mind is the budget backdrop for this year's budget.
So Nikunj, I have been tracking budget numbers very closely for last maybe 15, 20 years now. And I must say that these numbers look one of the best which I have seen at least. Because in the past, optically, the numbers may have looked very good. But behind that you had, some kind of a oil bonds which were off budget item. You had something in FCI which was there, which was off budget, right? The government took a bold decision last year and cleaned up all of that. So on once you had the rise in fiscal deficit, but now we are on the path of consolidation. And as you rightly said, it is all about credibility. So the government and the finance minister have established enormous credibility by giving us number last year. Right? They went on and said that the revenue will grow only at 10%. You have seen what has happened to tax collection. So they have collected 2.3 lakh crore rupees of more taxes than what they would collect rather. 2.3 lakh crore rupees of more taxes than what they had budgeted. There was an unfortunate event of the fertilizer prices going up, gas prices going up in the world, and that has in a way dented. Otherwise, our fiscal numbers would have been much, much better than what they are looking now, right? So my point is that that 6.5% fiscal deficit number, which was assumed by the government in the beginning of year, they, in my expectation, they will surpass that. It will be better than the 6.5% which was assumed. Also, it has got aided by the rise in the nominal GDP itself, which was projected to be roughly 258 lakh crore rupees. I think it will come more like 273 lakh crores or 275 lakh crores by the time we end the year. Now, even more important, Nikunj, is that when we go into the next year, our situation is very comfortable.
Why is it comfortable?
Because this subsidy number is unlikely to get repeated and the government is likely to save at least 1.5 lakh crore rupees on account of lower subsidy only. Right? Assume everything will be the same. There will be some revenue growth on a nominal basis. There will be expenditure growth on a nominal basis. But they have this 1.5 lakh crore rupees of surplus from subsidy itself. Then RBI this year likely to give only around 30,000 crores to the government. Now we have analyzed the balance sheet of RBI itself. Right? In my view, RBI has a leg room. Now how much they will give, I don't know. But they have a leg room to give at least 80,000 to 1 lakh crore rupees more only by way of dividend to government. So if I take both of this into account, so they will have roughly 2.25 lakh to 2.5 lakh crore rupees of extra ammunition, right, in this budget, which was not there last year, right? So I expect the current year number to be very good. Government fiscal situation is really good. Now, again, Nikunj, we have to take this into the backdrop where we are talking of recession, we are talking of developed economies. Yeah. And I given you the number, I'm sure you will share with your viewers, the developed economy fiscal deficit is higher than that of India.
Yes. So I'll talk about it. I'm coming to that graphic, but let's go back to the key assumptions. The first important number, fiscal deficit. And what Mr. Kela is making a point here is that imagine you have a bank account and you're starting with an opening bank balance. That is what the government balance sheet is, that this time around, because food subsidy is not there and RBI cushion is going to be there and there is an assumption in terms of growth, the government opening balance this time is very strong. So put things in context, Madhu, 5.8% fiscal deficit number for FY24 is an achievable target.
Achievable number, very much achievable. And I would say in the current context, government may choose that instead of 5.8, we will show 6%. I don't think heavens are going to fall because they will like to ensure that the economy is in a very good shape. They are aware that there is a global recession, there is a talk and exports are being impacted for sure. So whether it is 5.7 or 6, I don't think market will read too much into that as long as it is going for productive purposes.
The fiscal situation of the government is strong. So if one assumes a nominal GDP growth of 9 to 10% and a capital expenditure front, because 1 lakh crore rupees jo aayega, it can easily go back into capital expenditure. Are these two numbers reasonable? 9
So
to 10%?
let me just decode these numbers in a very simple terms. I expect, roughly, I expect government to do 25 lakh crore rupees of total revenue in FY23, and I expect government to do roughly 42 lakh crore rupees of total expenditure. Give or take, few thousand crores here or there, just for the purpose of simplicity. So we are talking your fiscal deficit will be in the range of 17 lakh crores, right? I expect, as the track record of the government is, that they will be conservative in guiding the revenue assumptions. So they may guide for maybe 10% revenue expenditure and revenue side, and on the expenditure side, obviously they will spend more. And that is the beauty, that capital expenditure as a percentage of overall expenditure last year was also 19%, which is one of the highest India has seen, one of the highest I would say. That 19% number is likely to go up more. Maybe it will be 20 or maybe slightly more than 20% in the current year. And as we discussed earlier, that government has the ammunition to do this extra expenditure. So if they do 20% of the total expenditure into capital expenditure, it will be a big boost to a lot of sectors and economy in general.
So the government also is now no longer doing a lot of wasteful expenditure of government tax collection, which is subsidy or any kind of expenditure which is not creating wasteful effect.
Exactly.
So the multiplier is very large.
This number used to be, Nikunj, 10 or 12%. The capital expenditure number of the overall expenditure used to be 10 or 12%. Now it is inched up to 19 or 20%. And that is what is getting reflected in the confidence of people when it comes to all the infrastructure projects being implemented. And we are seeing it all around us, right?
Okay. Every time when budget is round the corner, budget is also about taxes. We tend to discuss from in stock market side the importance of rationalization of taxes. In India, just to break it for our viewers, we've got different tenure and different tax rates. Different tenure if you're holding in equity, debt, real estate and gold. Similarly in India, if you are trading in F&O, different tax rate. If you're holding for more than 1 year, different tax rate. If you're holding for less than 1 year, different tax rate. Market nervousness, Madhu, perhaps is valid because the tax regime is different. There are two ways in which things could happen, and I'm just going to project it for our viewers. The short-term rates in India are 15%, long-term is 10%. If the short-term rate is changed in proportion with business income, will that be a negative news for the market?
So, Nikunj, let's first look at it. You be in finance minister situation. Capital markets have enabled raising of 6.5 lakh crore rupees of equity in the last 3 years, right? I would urge and pray that these things should not be disturbed, at least this year, because everything is going well. Capital market is helping revive the economy. Revival of the economy, given the global context which we discussed, is very, very important. So I think any meaningful distortion on the capital gains tax regime may not get government significant revenue boost up. And as we discussed, it is not even needed. If they get 10,000 crore extra, that is not even needed. So I think this thing can wait, and it should wait, right? There is a merit in rationalizing the taxes, but should it be done this year is my point. I am saying that logically speaking, given the context that markets have also become nervous, given the context that there is talk of global recession, and we need very healthy capital markets, it should not get distorted. Having said this, like, if the rates, if the time frame changes, let's say it long term goes from 1 year to 2
That
years.
1 year becomes 2 years.
2 year. I don't see a meaningful impact on the markets. But let's say if you change the short-term capital gains
this one here.
to business income,
Yeah.
let's say you club it with the business income slab, then I see a very meaningful impact on the markets.
So again, Mr. Kela is making a point that there is need to have versus good to have. Now you can argue that the short term, the capital market, capital gain should be changed, but that's good hygiene as per global standard. But the need to have is clearly not there given the global backdrop. There is no desperate need to raise taxes, and this also does not tally with the Prime Minister's vision of financial inclusion, because the SIP culture in India is just about picking up. You need a vibrant capital market,
And
when
we
you
have
are
lived with
positioned.
it. We have lived it for last 50 years.
Exactly.
In 1 year,
Exactly.
nothing is going to change.
Exactly.
But this year is very crucial for India, for us to be able to differentiate from the world.
And take that leap forward.
Take the leap forward. So this is, and I expect, I am sure government is more, will recognize it more than what you and I can discuss.
Of course.
That this year, the economy, the people need support. They need growth push. So they will optically utilize this 2.5 lakh crore rupees of buffer which they have, and make sure that the sentiment remains very positive. So I feel that there will not be very large tinkering on at least on the short-term capital gains tax.
Okay. And just to supplement that point, that in 2022, calendar year 2022, we've seen record outflows by FIs, but record flows from SIP investors. So it's the equity domestic wheel which is chugging. And when an asset class is getting created, you need to incentivize it. And that incentive, in a sense, is something which really needs to be protected. I'm going to wrap with one final question.
And also, Nikunj, there is a significant risk which people take. Markets are very volatile.
Yeah.
So obviously there has to be some incentive for people to be able to take this volatility. And we are paying taxes, right? We are paying STT, which is a very major tax from a capital market perspective. And whatever income which I have, I end up paying 18% GST.
Yes.
So on the whole, on my overall income, I am actually
And there's
paying a lot
tax
of
on dividend
taxes.
also.
Exactly.
There's tax on dividend
Tax
also.
on dividend also.
Yeah, yeah.
That's
Okay.
right.
Just to wrap it up with one final point, that is the importance of budget over the years getting diluted. We've looked at some data, and it seems to be indicating that yes, on the day of the budget, maybe a day before or maybe a day after, markets will have their own volatility. But on a 15-day period, on a 20-day period, that's how the data has been. Over the years, the budget volatility has come crushing down. Would you
There's
agree
no
with
doubt about it. I did a lot of things previously, 10 years back, all the taxation used to change, customs duty were changing, a lot of things were changing, and it was impacting a lot of sectors. And now, because of GST, introduction of GST, a lot of that has got simplified. Whatever changes which were supposed to have been brought in larger taxation, whether it is direct or indirect, they are all in place. It is unlikely. Now, we are not discussing today corporate taxation. You are not even asking me a question whether there will be a change, because it is assumed that all of those changes over the years are being done. So now, there is not that much market excitement vis-a-vis budget, except to see that we are actually walking the talk and we are in the right direction.
So if it's a status quo, this budget, I'm telling you, Madhu Kela is going to be smiling, and he's going to be smiling very, very clearly after the budget. And I hope it happens that way, that we're capturing your smile right now, and we continue to capture your smile after the budget as well.
Absolutely.
It's a good budget. It's the moment where India can really take the leap forward, because the global backdrop is uncertain, but India's positioning is so unique that the government's balance sheet, the corporate India's balance sheet, and also the retail balance sheet, all the three balance sheets are just aligning with each other. So what you really want from this budget is keep it simple and keep it very, very clear.